Part 1. In this video, we will reveal to you the secret of the most dangerous trading art, an art that few can master, but one that allows professional traders to achieve legendary profits in record time. Today, we will talk about short selling, or betting on a bear market, and how Jesse Livermore, known as the Great Bear, exploited moments of panic and collapse to write the greatest success stories in Wall Street history. If you want to understand how this art works and the psychological and mathematical risks it entails, follow me to the end, because this video will completely change your view of trading. The art of short selling, a journey into the psyche of the professional speculator. Buying a stock is an act brimming with hope, and fundamentally a natural act. It's a bet on growth, on prosperity, on the optimistic trajectory inherent in human enterprise. The trader who takes a long position is a partner in creation, a believer in the future. The public understands this person and applauds them. But selling a stock short, the short sale, or short, which is a bet on decline, is viewed as an unnatural, pessimistic, and almost predatory act. To be a bear in the market, a person who profits from ruin, is something the public will never comprehend and never forgive you for. Yet the professional speculator who seeks to profit from every major market fluctuation must be as comfortable on the short side as on the long side. Their thinking must be integrated and capable of handling both sides smoothly. Because the great market waves move in two directions, and ignoring major downward movements means ignoring half of the extraordinary opportunities this game offers. So this is an analysis of the most difficult, dangerous, and in the right hands, the most profitable art of speculation ever, the art of short selling. This is a deep analysis of the unique and immense psychological pressures the short seller must endure, and an exploration of the iron discipline required to survive and thrive in this most ruthless arena. Jesse Livermore was and remains the undisputed master of this aspect. He was the Great Bear of Wall Street, a man whose greatest legendary victories were born from his unparalleled ability to diagnose a market top with precision and the courage to back his judgment with his fortune. His career is the paradigmatic case study in the psychology of the short sale. A link to this book, Reminiscences of a Stock Operator, now with a unique and detailed analysis of each chapter by Max Davidson, is in the description of this video. This new analysis is specifically designed to make the book's timeless wisdom powerfully relevant to the contemporary reader. To understand the psychology of short selling, one must first confront the brutal mathematics that govern it. This is the fundamental and essential difference between buying long and selling short, and the source of the immense psychological pressure that crushes the average person. When a speculator buys a stock long, their risk is inherently limited. They may lose all their investment if the company goes bankrupt, but they cannot lose more than that. If they buy a stock at $10, the maximum possible loss is $10 per share. The price cannot fall below zero. But the short seller faces a different and more threatening reality. Their risk is theoretically unlimited. They sell a stock they've borrowed at $10, hoping it will fall. But there is no theoretical limit to how high this stock can rise. It can rise to $20, $50, $100, or even higher. With each slight rise, the short seller's loss deepens. While the long buyer's loss is limited, the short seller's loss is a terrifying, boundless void. This imbalance in the risk balance is the first and most important reason why the short side is a game for the true professional only. For the man with nerves of steel. This mathematical truth creates a psychological pressure unparalleled on Wall Street. The speculator holding a long stock at a loss is often propped up by the gentle, deceptive poison of hope. The speculator shorting a rising stock is subjected to the raw, instinctive, and direct emotion of fear. Every piece of good news about the company is a body blow. Every bullish rumor is a tightening of the vice. They are at war not only with the price chart, but with the optimistic consensus of the entire world. They are the person standing in the path of a stampeding herd. This pressure peaks during the phenomenon of the short squeeze. This is the speculator's nightmare incarnate. It happens when a heavily shorted stock begins to rise, forcing short sellers to buy back their shares to cover their positions and limit their losses. But this very act of buying fans the flames. Their desperate purchase pushes the price higher, forcing more shorts to cover, creating a vicious, self-reinforcing, explosive upward spiral. It is a financial torture instrument that has broken many. Part 2. In addition to squeeze risks, there is another aspect just as dangerous and more insidious: the critical importance of timing. On the long side, a speculator can be right about a stock's intrinsic value and can afford to be early. Buy and wait patiently for the trend to prove itself. On the short side, being right too early is often no different from being wrong. A speculator can correctly diagnose that a stock is overvalued, that a speculative bubble is ripe to burst. But if they establish their short position too early, before the final manic phase of the bull wave is complete, they will be wiped out by the rise long before their bearish predictions materialize. The market can remain irrational far longer than the short seller can remain solvent. The final convulsive surge at the end of a great boom is often the most violent. The short seller standing against this movement is trying to stop a freight train with their body. Therefore, the master of the short side must be a master of timing. They cannot act on their analysis alone. They must wait with the patience of a saint for the market itself to give the final, decisive signal that the top is in and that the line of least resistance has finally turned from up to down. Acting one day early can be a fatal mistake. With all these immense risks and pressures, why would any rational person choose to short a stock? The answer is simple: because the rewards, when you are right, are faster, more violent, and more spectacular than anything seen on the bull market side. The stock market takes months or years to climb the wall of worry. Greed and hope accumulate slowly, but the bear market, the market in panic, can collapse in weeks or days. Fear is a stronger, faster catalyst than greed. Therefore, short-side profits are compressed into a shorter, more violent time frame. The person who positions themselves correctly for a major decline can amass a fortune at a speed impossible for the long trader. This is the grand prize awaiting those who master this difficult art. It is the opportunity to profit not from slow, steady building, but from the sudden, catastrophic force of financial gravity. It is the opportunity to be the only prepared person when the world is in panic. This is why Livermore, the great bear, was drawn to this side. He understood that the greatest speculative opportunities were not in the orderly advance of the bull market, but in the chaotic collapses of the bear market. In these moments of extreme fear, his cold, emotionless discipline gave him his greatest edge. He knew that the successful short seller must be first a ruthless realist, able to see the world as it is, not as they wish it to be, able to diagnose the signs of a market top: rampant public speculation, stumbles of former leaders, heavy trading on massive volume even as the world heralds a new era of permanent prosperity. They must be contrarian, not out of contrariness, but as a result of disciplined obedience to market facts. They must have the courage to stand alone, to sell when everyone is buying, to be the only sane person in a mad world. This is not a game for the hopeful, the cowardly, or those needing crowd approval. It is a solitary and difficult path, requiring an exceptional degree of self-confidence and emotional control. The short seller bets against the strongest of emotions: hope. They bet that overextended market facts will prove stronger than the masses' desire for the rise to continue. In the long run, this is always a good bet. They must have a plan more rigid and disciplined than their long plan. Given the nature of unlimited risk, their stop-loss must be absolute and non-negotiable. Position sizing must be more cautious. They must understand they are dealing with the market at its most dangerous and volatile. Their defenses must be impenetrable. In these moments of intense pressure, when the position moves against you and everyone calls you a fool, the true character of the speculator is revealed. It is a test few pass. Therefore, the constant return to first principles is not a luxury but a necessity for survival. Returning to this channel, to this video and others, especially after a losing trade, serves as a vital recalibration of the mind towards the professional, scientific, non-emotional approach. The short seller must be the master of their mind, able to bear the psychological pain of a rise against their position, and have the discipline not to be fooled by a false move, but also have the humility to admit when their timing is wrong, to take their small loss and wait for a better opportunity. The line between courageous persistence and foolish stubbornness is thin, and the short seller must walk it every day. They are a person who has chosen to make their living in the eye of the storm. They are a student of panic, of fear, and of the recurring cycles of human folly. But for those who master this art, for the speculator with cold nerves, iron discipline, and a deep understanding of the game, the rewards are unparalleled. They are the ones who prepare for the flood, who build their ark while the sun is shining. Great panics and crashes are the moments when the greatest transfers of wealth in history occur. They are the moments when the undisciplined, hopeful, and unprepared public is forced to hand over their wealth to the cold, patient, and prepared professional. The short seller is that professional. They have done their homework. They have read the signs, and they have had the courage to act on their judgment. Their great profit is not luck. It is the fair and earned reward for their superior knowledge and supreme emotional control. Why then, after all these terrifying risks, would any rational speculator choose to engage in this dangerous act? Because in major devastating declines, in moments of general panic and collapses, the profits that can be reaped are faster, more violent, and often far greater than any possible profits, even in the strongest bull markets. The master speculator, who has freed their mind from the average person's bullish bias, understands a fundamental truth about the market's emotional mechanics. The bull market climbs a slow, arduous wall of worry. It is a long campaign. Greed and confidence accumulate gradually. But the bear market slides down a slippery, swift slope of hope. The driving emotion is not greed, but fear. And fear is a stronger, more immediate, more primal catalyst. A market that took 2 years to build can be demolished in 2 months. Major declines are not a time of fear for the professional. They are a time of unmatched, extraordinary opportunity. In moments of extreme pessimism and widespread hysterical liquidation, the cold, detached, and well-positioned short seller reaps their greatest harvest. This is the great advantage of the bear. They are a realist, accepting the simple truth that financial gravity, like natural gravity, is a constant and powerful force. And when the market is pushed to unsustainable heights by the optimism of the foolish crowd, they know the subsequent fall is not a possibility, but an inevitability. Let's reflect on examples from the master's career. The panic of 1907. Through his scientific reading of the market, Livermore diagnosed the deep sickness beneath the surface of the seemingly prosperous market. While others were in a bull fever, he built his great short position in his characteristic isolation. He was a lone wolf. When the market collapsed into panic, his profits swelled. His success reached the point where J.P. Morgan himself sent word asking him to stop because his operations had become a factor in the national financial equation. He had become the game itself. He covered his positions, helped reignite the rally, and emerged a multi-millionaire and a legend. His greatest victory was the crash of 1929, a decade of reckless speculation, a crowd drawn into a hysterical wave, an illusory belief in a new era. Livermore saw the signs of the top: speculation in worthless stocks, leaders stumbling on huge volume. He waited patiently for the final signal. When the decline began, he built his immense short position. In the Black Autumn of 1929, he was perfectly positioned. His profit from that campaign was estimated at $100 million, a colossal fortune.
Part 4. These victories testify to the immense rewards, but we must not forget the brutal mathematics of risk. The maximum profit from a short position is 100% if the stock goes to zero, which is rare. The potential loss is theoretically unlimited. A stock can rise infinitely. The short seller sleeps on a barrel of financial dynamite. This fact makes this side a game for the true professional only, with cold nerves and iron discipline. Amateurs, creatures of hope, do not survive here. Only the professional who has replaced hope with the science of risk management is capable. The stop loss, vital in long buying, becomes an absolute lifeline in short selling. One who shorts without a predefined stop loss is not a speculator, they are a madman. The final and most important lesson: the art of short selling can, in the right hands and conditions, create a legend. It can produce wealth with a speed and decisiveness rarely seen, but it is a tool of enormous and dangerous power that will completely destroy those who are not its complete masters. It will exploit every one of their emotional weaknesses with speed and finality. The speculator who will engage in this most difficult process must first have achieved complete mastery over themselves. Their mind must be a cold, clear, and precise instrument. They must have a proven scientific system of rules and the character and discipline to follow them without the slightest deviation, especially under pressure. The short selling side is no place for amateurs, dabblers, or hopeful gamblers. It is the master's domain, the ultimate and most challenging arena in the great and ruthless game of speculation. In the end, the art of short selling remains one of the most complex and dangerous arts in the trading world. It is not merely a financial process, it is a psychological, mental, and disciplinary test. The trader in a bear market doesn't just face numbers and charts, they face the fear of the crowds, rumors of optimism, and media pressure insisting the market will rise forever. This path is not easy. It is a path of solitude and discipline. The trader in a bear market stands against the majority, sells when everyone buys, and holds firm when others mock them. They need almost superhuman self-confidence and an ability to control their emotions under the harshest conditions. But the reward is worth it. Fast, massive, and violent profits, impossible to achieve in a bull market. It is an opportunity that comes only in moments of panic, when wealth transfers from the undisciplined crowd to the cold-nerved professional. Short selling is not a game for amateurs or the hesitant. It is the arena of professionals who possess the psychological discipline and the ability to control themselves. It is a difficult art, but for those who master it, it opens doors to legendary, unmatched profits. Jesse Livermore was the living example of this, a man who faced the markets at their toughest moments and emerged a legend. He didn't win because he was lucky, but because he was disciplined, realistic, and cold-nerved. He knew that the bull market is built on hope and greed, while the bear market collapses under the force of fear, and fear is always faster and stronger than greed. If you want to be a professional trader, it's not enough to learn how to profit in a bull market. You must also learn how to face the bear market with the same strength and discipline. You must be psychologically prepared, establish strict risk management plans, and know that short selling is not gambling, but a science based on accurate tape reading, on discipline, and on the courage to face the majority. In moments of collapse, when fear reigns and markets crash in days or weeks, the professional trader who prepared in advance emerges. While the public, drowning in hope and greed, loses, they are the only ones profiting from the force of financial gravity. This is the real message. Trading is not just about numbers. It is a reflection of human nature, of hope and fear, of greed and panic, and the one who understands this nature and knows how to exploit it with discipline is the one who writes the greatest success stories. Short selling is the art of surviving in the heart of the storm, the art of confronting panic, and the art of transforming collective fear into personal opportunity. It is the difficult path, but it is the path that creates legends. I share with you daily, precise, free analyses on the Euro-USD pair, so you're always informed of the best opportunities in the market. And for those who wish to enter and exit trades with professional risk management, whether in funded or personal accounts, you are welcome. Now it's easier than ever. You can contact us directly via the dedicated WhatsApp link, where our team is ready to answer all your questions and provide you with all the details about our trading signals. And because we believe experience is the best proof, we offer you a golden opportunity. Get your first month completely free to try our carefully selected signals. During this month, you will see for yourself the power of our signals and how they can help you achieve outstanding results and elevate your trading level. Our signals are not random. They are based on accurate analysis and long market experience. We focus on carefully studied trades and provide you with continuous support to always be aware of the best opportunities. Imagine having clear signals backed by experience delivered directly and easily via WhatsApp or Telegram. All you have to do is join us and try the free month, and then the decision will be in your hands. Don't waste time. Contact us now via the WhatsApp link and begin your journey with precise trading signals, well-considered trades, and continuous support that will accompany you step by step towards success.